Welcome to Talk Tickers. You're here for our breakdown of the latest financial insights.
And today, we're jumping straight into Pagaya Technologies.
That's right, their first quarter 2025 earnings call.
Yeah.
Our plan, we'll pull out the key numbers, talk about what management said drove things, and maybe even toss around an interesting idea based on all this.
And look, the big headline here seems to be Pagaya hitting GAAP net income profitability. That was a quarter sooner than expected.
A really significant milestone. Definitely something management focused on.
Absolutely. It's a key focus for them going forward, they said.
Okay, let's hit the quick numbers then. Revenue growth was 18% year over year.
Yep, putting that annualized run rate near $1.2 billion. Pretty strong.
And fee revenue less production costs, the FRLPC metric?
That jumped 26% year over year. Annualized, that's over $460 million.
Okay, so solid growth there. And adjusted EBITDA?
Doubled, 100% growth, basically. Annualized, that's around $320 million.
Wow. But the real standout you mentioned?
GAAP net income, $8 million for the quarter. First time they've posted a positive GAAP number since going public.
That GAAP profitability, doing it ahead of schedule, it really does send a strong signal, doesn't it?
It suggests the business model is, starting to generate sustainable profits by standard measures. That's often key for long-term financial health.
All right, let's dig a bit deeper then. Network volume was $2.4 billion. That sounds kind of flat year over year.
It was overall, but they made a point of saying if you pull out the single-family rentals, the SFR business.
Right, which seems less of a focus now.
Exactly. If you look at the core lending volume, that actually grew 26% compared to last year.
Okay, that's a much healthier picture.
And up 6% just from the previous quarter. Personal loans, their biggest piece, saw volume up 17% year over year.
And conversions, were they still managing to convert applicants effectively?
Apparently so. Application conversion rates held steady right around 1%.
So maintaining efficiency even with higher volume? Good sign.
Yeah, suggests they're finding and converting customers well.
What about total revenue? They hit a record, right?
$290 million in total revenue and other income. Fee revenue was most of that, $283 million, up 19%.
And that was driven mostly by personal loans and auto?
Primarily, yes. Higher fees in both those areas.
And back to that FRLPC number, $116 million. Yeah. You said 26% up year over year.
Right. And as a percentage of network volume, that's 4.8%. Or 5.2% if you exclude SFR.
And an interesting point here is that the actual lending product fees are making up more of that FRLPC now.
Yeah, 77% in this quarter. It shows they're, capturing more value directly from the loans going through the platform, strengthening the core.
Okay. And adjusted EBITDA, we said doubled to $80 million, margins over 27%.
Wow. Adjusted net income positive, too, at $53 million.
And here's a number that really caught my eye. Net credit-related losses.
Yes. How did those look?
Huge improvement, down to $24 million. Compare that to $229 million in the same quarter last year. That is a massive difference. What's behind that?
Likely improvements in their underwriting models, maybe better loan quality overall. It really impacts profitability.
And they mentioned lower interest expense, too.
Yeah, down sequentially and year over year. They said that's from optimizing the balance sheet. So better credit performance and lower financing costs, boosting the bottom line.
So what was management saying drove all this? What were their main points?
Well, they talked a lot about the durability of their model, how it's diversified. They have twice as many lenders contributing significant volume now compared to last year.
So broader partner contribution.
Right. And they're expanding loan types, product selection. There's a new forward flow deal with Blue Owl Capital.
Another funding source.
Yeah, up to $2.4 billion in loan purchases over 24 months. That's on top of their existing deal with Castle.
Gives them more predictable funding capacity.
Exactly. And management seemed quite comfortable with their cash position.
They said no plans to raise equity.
None in the foreseeable future, they said. They emphasized a prudent and balanced approach to growth.
Meaning cautious given the macro environment.
Yeah, they acknowledged the uncertainty, but also noted that consumer credit behavior seems stable. Still, they're being careful.
Focusing on long-term, responsible, profitable growth. Leveraging their data, their tech.
That's the message. Build the franchise for the long haul.
Any specific product updates? Personal loans?
They highlighted progress there, especially with pre-screen solutions and using marketing affiliates like, Credit Karma, Experian, Lending Tree.
To drive customer growth for their partners.
Right. They said the initial tests, the proofs of concept have been encouraging.
What about auto lending? That seemed to bounce back.
Big time. Almost a 50% sequential jump in volume.
Wow, why the surge?
Better risk modeling, funding efficiency improvements, more partners, and favorable vehicle costs apparently all played a part. The annualized run rate there is over $1.1 billion now.
So auto's looking strong again.
Seems so. And they also briefly mentioned point-of-sale lending as growing rapidly. Strong demand there.
Okay, let's touch on funding again. You mentioned the Blue Owl deal.
Well,
anything else?
They're evolving their funding overall, expecting non-ABS funding to play a bigger role in 2025, maybe 25% to 50%.
And that lowers their risk retention needs.
Correct. Makes them more capital efficient. They've also improved their ABS programs and diversified their funding base. I think they said 135 institutional partners now.
So they're finding ways to fund growth efficiently. They did quite a bit of ABS issuance too.
Yeah, $1.4 billion across 3 deals in Q1, plus another $800 million raised in April ABS deals.
And the balance sheet looks okay.
Seems solid. $230 million in cash and equivalents, plus $760 million in investments in loans and securities.
All right, let's turn to the outlook. What guidance did they give?
Okay, for Q2 2025, network volume expected $2.3 to $2.5 billion.
Like?
Total revenue and other income, $290 to $310 million. Adjusted EBITDA between $75 and $90 million.
And GAAP net income for Q2.
They're guiding to between break-even and positive $10 million.
So aiming to stay profitable on a GAAP basis. What about the full year 2025?
They raised the guidance across the board. Network volume now expected $9.5 to $11 billion.
That's an increase?
Yep. Total revenue and other income also up, now $1.175 to $1.3 billion. Adjusted EBITDA increased to $290 to $330 million.
And the big one, full year GAAP net income.
Guidance increased there too, now expecting $10 million to $45 million for the full year.
Raising full year GAAP guidance, that really does signal confidence, especially after just hitting profitability.
It absolutely does. It suggests they see the Q1 performance as sustainable and expect continued momentum despite, any macro worries.
So wrapping up the investor view here, that GAAP profitability ahead of schedule, that's probably the key takeaway.
I'd say so. It could signal a real turning point for the company, showing they can generate sustainable value.
And the strong growth in FRLPC, adjusted EBITDA that points to operating leverage kicking in, potential for more margin expansion.
Yeah, that seems to be the case. And their funding diversification, navigating the ABS markets, it suggests a more resilient business overall.
Those investments in pre-screen and marketing for personal loans could be important growth drivers going forward.
Could be. And that rebound in auto lending is definitely positive after they spent time focusing on underwriting and funding there.
So overall, the raised guidance reflects pretty strong confidence from management, despite the cautious tone on the macro side.
Yeah, the market probably likes seeing that move into GAAP profit and the raised outlook. The question now is, can they keep it up? Investors will definitely be watching that.
Okay, time for our This Is Not Financial Advice segment, where we explore a, let's say, thought-provoking idea.
Always fun. What have you got?
All right, so Pagaya has obviously shown strength in AI underwriting and accessing capital markets, right?
Definitely. Core strengths.
So here's the outrageous but plausible thought. What about taking a look at companies that provide the underlying tech infrastructure for lending? Specifically, loan servicing software.
Okay, go on.
As Pagaya grows, and maybe partners even more deeply with traditional banks or lenders who need to modernize.
The need for better, more efficient servicing tech could increase.
Exactly. These software providers could become kind of essential plumbing for the next wave of AI-driven lending that Pagaya represents. It's an indirect play on Pagaya's success and the broader digitization trend.
So a potential beneficiary of the whole ecosystem shifting, it connects Pagaya's front-end AI with the back-end processing. Interesting angle.
But, purely speculative. Lots of ifs involved. Definitely do your own research. This isn't a recommendation.
Of course. It's about exploring potential ripples and connections in the market, a good thought exercise.
So that wraps up our deep dive into Pagaya Technologies Q1 2025 earnings call. We hit the numbers, the management commentary, the outlook,
and tossed around that speculative trade idea.
We hope this breakdown gave you some valuable insights. What stood out most to you from the call? We definitely encourage you to dig into Pagaya's reports yourself.
And just a reminder, as always, this discussion was for informational purposes only. It's definitely not financial advice.
Your own research and understanding your risk tolerance are absolutely key.
Couldn't agree more.
Thanks for tuning in to Talk Tickers. Join us next time for another earnings call breakdown.